The first futures exchange appeared in Japan, 1730. The Dojima rice market in Osaka was a trading center for rice, and a rice futures market naturally evolved there. Because the role of rice in Japan was also monetary, the rice bill futures that emerged in Osaka are considered the world's first financial futures. Does this matter to you, individual investor? We'll see. Our account starts with what motivates futures in the first place. If you are a farmer looking to sell your crop 60 days from now, how do you avoid losing money if crop prices fall until then? This is the same business problem a widget exporter faces. She exports today, but will get paid 30 days from now. How to avoid losing money with currency swings? Individual investors buying real estate overseas face similar risks. All these business problems concern risk. How to protect yourself? You can solve this problem with forwards or futures. Let's compare and contrast. A forward contract is a private agreement between two parties to exchange an asset at a future date for a price agreed upon today. Forward contracts are custom, not traded, and thus subject to counterparty, liquidity, and credit risks. A futures contract is also an agreement to buy or sell an asset in the future. But futures are standardized, exchange-traded, subject to margin, and daily mark-to-market. Futures evolved from forwards in Osaka, in the 1600s. In the Tokugawa period, Japan was a feudal economy, with a population estimated to be stable at roughly 30 million people. Of this, 87% were farmers, 5% were warriors, and 8% were merchants and artisans living in cities. But according to historian Noritaka Dohi, the population in the city of Osaka doubled from 200,000 to 400,000 in the same period. Why did this happen? In short, Osaka became Japan's kitchen. How did Osaka become the hub for rice trading? One reason was policy. Feudal Lord Toyotomi Hideyoshi placed his castle in Osaka and improved infrastructure with a channel system, requesting merchants to gather on a single spot, called senba, where an active market evolved. Another reason for Osaka's central role in rice markets was geography. It was located on roads connecting Japan's east and west, and it was even more important as a port with many rivers, channels, and waterfront warehouses. Because rice was the most important product of Japan's, then agrarian economy, and largely homogeneous, it was the basic unit for taxation. The size of a parcel land was measured in the amount of rice it produced. Taxes were levied in rice, and civil servants were paid in rice. In the Tokugawa period, rice was used as a means of payment. Historian Suzuki explains that rice bills were introduced to minimize the transaction costs of trading large volumes of rice that arrived in Osaka during a short period of time. Without the securitization of rice trading, it would have been more difficult to smooth out rice consumption over the year and over Japan, and large temporal price fluctuations would have resulted. Eventually, rice bills took the form of futures contracts as futures trading in rice emerged in the late 1600s. All feudal lords had their own rice warehouses in Osaka by the 1670s. In 1730, authorities officially acknowledged Osaka's rice market and its central trading place of Dojima as an exchange. The world's first futures market was born. Professor Ulrike Scheide explains that Osaka's futures exchange developed without guidance from financial authorities. It materialized solely in response to the needs of market participants, who made up their own rules in a way that best suited their needs. The exchange was an autonomous, voluntary, non-profit association of its members, and its main function was supervising everyday trading, so it regulated brokers and auctions, settled disputes, registered official daily closing prices, and collected fees for its operations. Its evolution was trial and error. Individuals traded rice bills either to speculate on price fluctuations or to shift risk onto those willing to bear it. A trader who auctioned rice at the warehouse and intended to sell it in a few weeks could hedge his assets in rice bills against a possible decline in prices by taking a futures position. A rice wholesaler who signed a contract to deliver rice at a future date, without having the rice at hand, could hedge against a possible increase in prices by taking an opposite futures position. Professor Shada explains that modern-day futures markets must meet the 6 following criteria. First, only exchange members may trade. Second, contracts are standardized. Third, for each position, money must be deposited at the clearinghouse. This is called margin. Fourth, trading is not bilateral. Each trader trades with the clearinghouse, which guarantees the fulfillment of all contracts. Fifth, as the futures contract runs over time, open positions are reassessed daily given price fluctuations. Sixth, positions dissolved before the end of the trading period are cleared by cash settlement with the exchange. Professor Shada continues, Dojima market practices satisfied these 6 criteria, except that it had different margin rules, a different mark-to-market mechanism, and several clearinghouses rather than just one. The Dojima rice market is a reflection of the sophistication and ingenuity of Tokugawa period Japanese merchants. We thank them for it. After Osaka in 1730, it took over 100 years for other futures exchanges to emerge around the world. In the UK, the Liverpool Cotton Brokers Association promulgated rules about forward sales first in 1864, and then more extensively in 1871. The Chicago Board of Trade adopted formal rules on futures trading only in 1865. In 1870, cotton traders incorporated into the New York Cotton Exchange to trade futures contracts. In present day, futures exchanges are present in all continents. Our verified sources are shown here. We encourage you to tell us if your interpretation is different, or if you'd like to suggest other verified sources. What do these tell us altogether? Historians seem to agree that Osaka was the world's first futures exchange. It was invented to address business problems associated with rice trading. What are the takeaways for individual investors? Should you trade futures too? Unless you run a business exposed to commodities, currencies, or interest rate fluctuations, you probably do not feel the need to trade in futures. Regardless, if you do choose to plunge into futures, you'd better prepare very well. For every futures contract that expires, there's a winner and a loser. You would not be trading against amateurs. And all futures come with margin and thus leverage. Perhaps unsurprisingly, many amateurs and pros alike blew up trading futures. As we saw earlier in this channel, the world's first stock exchange was also created to solve a business problem. This is something the Dojima Futures Exchange and the Amsterdam Stock Exchange have in common. Another commonality: the immediate emergence of professional speculators in both markets. Does it mean speculation is for everyone? It does not. Thank you for watching. If you'd like to see more financial history from verified sources, subscribe to our channel and join our community of individual investors who strive to learn from the misfortunes of others to avoid similar fates.